I think you make such an important point because for a decade, we had such low interest rates, zero, and, such easy monetary policy, not just in the United States, but across the world. As you see that being removed, it has to be disruptive, right? And I think at the end of the year, markets were reacting to the unwind of the Federal Reserve's balance sheet as much as the raising of interest rates. So I ask you, do we even have the wiggle room, if you will, in terms of cutting rates where they are?
No, I think you could look at the level of interest rates and compare that to zero and think about that times the duration of the assets. And that is the power that you can have in having financial assets impacted by easing of monetary policy. Then you have to ask yourself in terms of the balance sheets, how much can the balance sheets be increased? What would be purchased? And so on. So what scares me the most longer term is that we have limitations to monetary policy, which is our most valuable tool. We have important limitations to the effectiveness of that. At the same time as we have greater political and social antagonism. So the next downturn in the economy worries me the most. I think that there are a lot of parallels with the late 1930s. 1929 to 32, we had a debt crisis, interest rates hit zero. Then there was a lot of printing of money, purchases of financial assets drives financial asset prices higher. Creates also a polarity, a populism, and an antagonism. We also had then at that time the phenomenon of a rising power like China dealing with the conflict of an existing power. These types of political issues are now very connected to economic issues in politics. So I think that that's the character of the environment we're in.